Welcome back. In today's session, we're going to take a look at the case for international diversification. I think most of us recognize, even at an intuitive level, that it makes sense to spread your investments over several different geographic areas, if for no other reason than to reduce risk by not putting all of your eggs in one basket. There are other reasons that are important as well. Among these, the lack of correlation between those markets, and also the opportunity to invest in emerging and growing markets. In today's session, we'll look at some of the pros and some of the cons and some of the risks that we can and perhaps should manage. So as well as the risk from the investment, we have the risk that comes from currency, or the risk that there's a movement in the spot rate for the currency that we report in versus the currency we invest in. If you take a look at an example that comes from the Solnick-McLeavy textbook from chapter 9, you can see here we've got an example where the standard deviation for our portfolio, for our investments, is 16.5%. The standard deviation of the currency, the volatility, the uncertainty that comes from the currency, is 8%. And in this case, we have a correlation coefficient between the portfolio and the currency of only 0.1. Now remember that our correlation coefficient is measured on a scale of +1 to -1. So 0.1 essentially means that there is very little effect of one on the other. The correlation is very low. It's practically random. So if we wanted to measure the risk in domestic currency and effectively the contribution of currency risk to our overall investment in this overall portfolio, we can take a look at the calculations. We'd start off by taking a look at the variance of our portfolio. Calculation of the variance, or the sigma squared, for our overall foreign investment is going to be the standard deviation squared, or the volatility, plus the volatility of the underlying currency, the sigma s squared, plus 2 times the rho, 0.1, times the standard deviation times the standard deviation of the investment, the standard deviation of the stock. That comes out to 0.0362565, or 3.6%. If we take the square root of that, we get the standard deviation of the portfolio. So the square root of 0.362 is 19.04%. Our overall contribution then of currency risk to our investment is going to be the sigma for the investment minus the overall standard deviation that we've already identified. The standard deviation for the investment was 19.04. We just calculated that, subtract the 16.5 that we had from an earlier example. Overall contribution of the uncertainty that came from investing in a foreign currency, 2.54%. Remember that volatility can be a good thing, because when we take a look at risk and return, we see that with more risk-return opportunities, we end up with a higher efficient frontier. Looking at the standard domestic efficient frontier that we talked about in courses like MBA 521, the risk-return trade-off line is going to be essentially this lower line. When we add in all of the international opportunities, we see that we have got a higher one. And that means that we can operate anywhere on this curve. So if you want to run a portfolio which is seeking a higher level of return, for a given level of risk, we can operate at point C with the same level of risk and a higher rate of return, or we could go for a lower level of risk like point B. So by pushing out the efficient frontier, by including riskier stocks, including ones that incorporate that higher currency risk, we end up with a better portfolio. Now, portfolios improve when we have got lower correlation coefficients. Here we've got a table that comes out of the Solnick textbook that shows 2 different views of correlation. And essentially we have on these axes each country versus itself, United States versus United States, and by only investing in American markets we have a correlation coefficient of 1, which means there's no benefit. If we were to operate from the United States and invest in Canada, we could have a correlation coefficient of 0.72. However, that also includes some kind of a return or some kind of additional risk as a result of currency. So accounting for currency in the gray scaled areas in this chart, you can see that we have got returns which are adjusted for hedged currency, or with the currency effects removed. So our correlation coefficient is a bit higher for Canada if we account for hedging. You can see some of our best returns in the unhedged portion here suggest that we can have perhaps as low a correlation coefficient as 0.3 or 0.2 by having investments in, say, Japan and Italy. Low correlation coefficient between those markets. And even if we account for the effect Japan versus Italy hedged, there we go, 0.36, we still have a substantial improvement over the 1-to-1 correlation coefficient that we'd have if we stayed in our home market. So the message here is that random correlation is going to work, but even better if we can find one with the right kind of currency exposures. We have seen that in a typical year or a normal year, markets tend not to be affected the same ways. If we have investments in 3 different markets, here we have the United States, Japan, and Europe. The blue line represents the United States, the green line represents Japan, and the pink or the purple line represents Europe. In many years, when the United States is, for example, 1991, the United States is having a really bad year, and Europe is having a good year. Japan somewhere in the middle. A little bit later on, Europe is having a really bad year, around 1993, or a bad quarter. And the United States is having a very good one. So by investing in both of these markets, in some cases with negative correlation coefficients, apparently, we've got the best of both worlds. We're able to get to average our returns to not have a particularly bad downturn, to smooth the returns to our portfolio. Although that isn't true in every year. In fact, in some years, especially when we have crises, the correlation coefficients tend to be very small. We take a look at the market correlations, not just of stocks, but of stock markets, to see what the type of market exposure and market correlation is going to be. The degree of independence of a stock market is linked to the independence of that country's economy and the government policies, but also of the nature of its economy in terms of what does it produce. Purely national or regional factors may be an important part in asset pricing and may lead to perhaps a lack of difference between certain markets. We'd also say of stock markets that certain stock and bond markets are systematically monitored by international money managers in order to benefit from not just diversification, but from non-random or selective diversification. So we look at the correlation coefficients in order to find low correlation coefficients to give us the best risk diversification. There may also be certain kinds of technological specialization, or perhaps focus on different sectors, such as things like tourism versus being a resource economy, having more of a commercial economy versus a manufacturing economy, that will accentuate that low correlation coefficient. And as well, there may be cultural, legal, sociological, political differences that may affect this as well. If we take a look at the history of stock market correlation, with this blue line representing the years in which we've seen high correlation coefficient, for example 2008, 2009, we had a very high correlation coefficient because of the financial crisis, with most economies doing particularly badly and doing badly together. Perhaps some of these other years, 1987 when we had Black Monday, or 2001 when we had the dot-com bubble, we saw higher correlation. But we essentially see, if we take a look at a longer-term moving average, a 5-year moving average, in order to smooth out some of those bumps, a general overall trend towards, at least during the years 2000, of correlation, but perhaps that moving average is heading in the other direction, heading downwards. And remember, we want to see a low correlation coefficient in order to take best advantage of international markets. The correlation of bond markets, again, with the unhedged in the bottom and hedged in the top, with the currency effect smoothed out in the top part of this diagonal graph. If you were interested in investing in bond markets, you'd see that there are even greater diversification effects. In some cases, in rare cases, perhaps even a negative value in those markets. And ignoring, of course, the far right column and the bottom column, bottom row, where we talk about equities, we can see that there are substantial gains from investing in different bond markets, not just investing in the United States. So it would make sense, for example, if most of your investment was already in Canada, to look for a market with relatively low correlation to the Canadian market, unhedged, perhaps looking at France or Switzerland or Japan. When we take a look at the effect of hedging, Switzerland and Japan are quite a bit stronger because there is a predictable currency effect that comes as a result of inflation differentials that we talk about when we look at parity relationships in the next series of videos. So in general, long-term bond return variations are not as highly correlated as equity valuations, but there perhaps may be some regional blocks, South America, European bloc. So bond markets in Europe tend to be highly correlated, approaching 1, especially for government bonds. So there are excellent diversification benefits to an investment, to an American or an Asian investor who's looking to invest, say, in Europe. Some of the things that cause bond correlations to be lower, the differences in national monetary and budgetary policies, fiscal policy as well, that they tend not to be highly synchronized, except perhaps to a degree among some of the most developed economies who do coordinate in some things. And some countries will affect a contrarian policy or leaning against the wind policy, where they raise their interest rates to defend their currency in a market which tends to be a little bit rough. We can see the effect of interest rate diversification from this chart from Vanguard, suggesting a more global bond allocation. Here, essentially, we'd say that if you're a Canadian investor looking for the maximum level of diversification, countries like New Zealand might offer the greatest opportunity for diversification. Perhaps other countries like Norway or Ireland as well. The lowest correlation coefficient represents the greatest opportunity. And there's also the advantage of time. And in fact, if you're part of an international market, you can pretty much trade in a nearly 24-hour cycle. We know from our own experiences that it can be awkward trying to trade according to Eastern Standard Time because of the 3-hour time difference that we have on the west coast of Canada. Imagine what that time difference is like if you're trading from China or the Middle East with an 8 or a 12-hour time difference. Now that we have got stocks trading in several different markets around the world, with Tokyo trading from, according to Eastern Standard Time, at about 7 o'clock our time until about midnight or 1 in the morning. And then about 3 in the morning London starts up, and you can trade from 3 in the morning our time, or Eastern Standard Time I should say, until about noon. And you can trade in New York from 9 to 3:30 in the afternoon. And so this essentially means that we now have stock markets that allow you to trade in stocks on a nearly round the clock cycle, which has got the effect of, since we can express our opinions about the future on a regular basis, lowering that correlation. But we'll come back to that later. This is an argument against, if you like, an international portfolio. One of the ways, of course, we measure the effectiveness of our portfolio strategy is to take a look at the Sharpe ratio. And of course, we remember that the Sharpe ratio is to take a look at the alpha divided by the standard deviation, or the return in excess of a risk-free return or standard low-risk portfolio divided by its volatility. And so for that, we use the Sharpe ratio. That's something we've already seen. The Sharpe ratio measures the excess return per unit of risk, and it's our job to try to maximize the Sharpe ratio. Introducing foreign assets gives us the opportunity to be able to improve on a domestic Sharpe ratio, and you can see that in this example. Here we've got some information. The standard deviation of our foreign portfolio is 15%. Standard deviation of a domestic portfolio, 12%. The correlation coefficient for those two, 0.55. The expected return from our foreign portfolio is 12%. The expected return from a domestic portfolio is 10%. And the cost of capital, the risk-free rate, either way, for domestic and foreign, is both 4%. Although that's not a requirement; it just makes it simpler to do the calculation. If we're using that data, we put that into an example, again from the Solnick textbook, and we can see that the domestic calculation of the Sharpe ratio is going to give us a return, expected return of the alpha of 10% return to the portfolio minus our risk-free rate of 4%. Divided by the 12% standard deviation gives us a Sharpe ratio of 0.5. If we calculate the foreign Sharpe ratio, same kind of calculations, we end up with a slightly higher Sharpe ratio, 0.533, and that's because of the higher volatility, the higher standard deviation, as compared to an even higher rate of return. How does it work if we have got a portfolio made up of both domestic and foreign assets with these two calculations of the Sharpe ratio? Well, the expected return to our portfolio, if it's made of 50% or 0.5 weight of the domestic and 0.5 weight of the foreign, says our overall rate of return to the portfolio is going to be 11%. And our risk-free rate doesn't change, it's still going to be 4%. So we see here in the numerator for our Sharpe ratio, our international Sharpe ratio, expected rate of return will be 11% minus 4. And that's our alpha. And that's going to be 7. The calculation of the portfolio standard deviation, the formula that we recognize, the very awkward and painful one, essentially says we're going to take 50% of our return from the domestic market with a standard deviation of 12%. We're going to take 50% from the international, or the foreign standard deviation at 15%. And then our correlation coefficient term is going to be 2 times the weight of domestic, the weight of foreign, the correlation coefficient of 0.55 times the standard deviation of the domestic and the standard deviation of the foreign. That gives us our volatility. Take the square root of all of that, and that gives us the standard deviation of 11.91%. Since that's lower than either of our opportunities before, it gives us a better Sharpe ratio. In fact, our options were a Sharpe ratio of 0.5 for the domestic, 0.533 for a foreign, and a Sharpe ratio of 0.588 for an international portfolio. The highest Sharpe ratio is the best, and so we'd say this one is going to be better than either of the domestic or the wholly foreign alternatives. Remember the currency risk in our global currency, our global portfolio. The depreciation of one currency is often at least partly offset by the appreciation of another. Our market and currency risks, therefore, are not going to be additive unless they're perfectly correlated. The exchange rate of our investment can be hedged in major currencies by using futures contracts, forward contracts for ongoing investments, perhaps swap contracts, something that we're going to discuss a little bit later on in the course. And the contribution of our currency risks then should be measured for the entire portfolio. It is probably going to be less than the sum of its parts because of the hedging opportunities. The contribution of our currency risk is also going to decrease with our investment horizon because while we're not very good at predicting short-term currency risk, we are quite good at the long term. Now, we have to remember there also is a case against international diversification. One of the major things that we've seen is that international correlation has trended upward as the world's become more of a global economy. Of course, the world is moving the other way at the moment, so that may be a reduced factor. It's also been observed that the value of our correlation increases at times of high market volatility. So when you really want the diversification to work, sometimes it doesn't. So we saw at times like 2001, 2008, 2009, and today that there is a higher correlation of markets. Markets tend to follow each other because they are lacking information. Markets that used to be completely separated or segmented are now becoming part of a more globally integrated world. So some markets, for example, Korea, which sought to be more independent, and in most things have now decided that it's better to be part of a regional trading bloc. China as well. South Africa is a brilliant example of increased integration of markets. So that also means lower value or lower benefits from diversification. So increases in correlation due to factors like deregulation, mobility of capital, reduced taxation of capital at borders, increased trade either through free trade or trade within blocks, and the globalization of those multinational corporations. Capital mobility has increased, especially in those developing countries that used to have the lowest correlation coefficients. The country-specific argument against diversification tends to rise during periods when the domestic market does better than those other markets. Why are we investing in these developing countries when we could be getting as good a return in our home market if our Sharpe ratio at home is perhaps higher than the foreign markets? And of course the answer to this partly is going to be that we have that correlation coefficient that provides us with some benefit. If it's gone, there's no benefit. We'd say that correlation seems to increase dramatically during times of crisis, as we saw, and the benefits disappear when they're most needed. There's a correlation breakdown. Here's an example that we see in heading into the dot-com bubble. If you were looking at country correlations, they tended to rise pretty much throughout the entire crisis. So if we were looking from the year 2000, December 2000 to December 2001, the world economy is getting worse. Correlation coefficients are increasing. However, we would have actually had more benefit by being diversified across industries, which actually did get better. There are a number of barriers to international investment that are still existing and will probably always exist. In some cases are becoming more extreme. One is our lack of familiarity with foreign markets, the cultural differences, the differences in the legal system, things that we don't really understand, the way that people work together in business, the way the business is structured. So just that difference is going to be the obvious part of this. There are also going to be political factors at the country level, the regional trading bloc level. So there's the risk of instability, the type of sovereign risk, the risk of discrimination against foreign firms. Market efficiency may also be a factor. It's maybe easy to get your money into the market, but difficult to get it out. There may be capital taxes that stop you from removing money from country once you get it in. The currency shortages, perhaps you have to apply to get foreign exchange to not only remit your capital if you want it back, but dividends and even interest repayments. So there may be a variety of different types of controls that will make market efficiency worse. Price manipulation for trading within markets might also be a factor that markets lack the transparency. Insider trading might actually be seen as something which is a normal part of trading practice. And of course, we have got the currency risks, although those can be hedged with derivatives. Regulations may be another factor. Regulations that change or lack of transparency, perhaps even a difference in the rule of law. Taxes may be a part of this. The most important of these are withholding taxes, which essentially says that we can't remit the returns to our parent organization without having essentially proven that the company has paid taxes at some place along the line. And double taxation is still going to be an important part of this. We also have got higher transaction costs, including things like brokerage commissions. Brokerage commissions can be much higher than they are in domestic markets, and there are all of those other transaction expenses. For example, failure to complete investments and inability to trade in relatively large blocks. So those things will put an impact on the total cost of a trade. Other transaction costs, custodial costs, a management fee, if you like, on the management of stocks. Money management fees may be higher because of the opacity or the difficulty in proving information. Difficulty with accounting systems being different, especially if the country is non-IFRS, and more difficulty in just gathering information. And that leaves us with our last example, and that's the case for emerging markets. Essentially, emerging markets are important to us because the ability to find growth is much greater in emerging markets than it is in domestic markets. A country that's been growing at 2 and 3% for the last 20 years is seen as being much less attractive than one that has the potential to grow at 5 or 6% for a prolonged period of time. Along with this, we've got all kinds of other interesting local risks with the stocks as well as with the underlying businesses. More volatility, problems with liquidity, political risks. They may also have much lower risks, still have a positive, but a relatively low correlation with our developed markets, which makes them more attractive. And according to the Solnick text, the correlation with the World Index of Developed Markets is perhaps as low as 0.64. The volatility of emerging markets is going to be larger than that of developed markets, just by the very nature of those markets, the uncertainty that's inherent in business. And investment risks is often exacerbated by periodic but significant financial crises, like the Mexican peso crisis, the Asian financial crisis, the Russian ruble crisis, and so on. We'd say about volatility, correlation, and risk. Distribution of returns is not symmetric. In other words, the upside and the downside may not necessarily reflect each other. There's going to be other factors than the mean and the standard deviation that affect returns, things we describe as skewness or kurtosis. A successful outcome may be a very successful outcome, and the averages might be in favor or set against an average outcome. So we can't count on this rules of statistics being able to predict the outcomes. Some of the returns are a result of a one-time effect of political reform and liberalization. There may be other factors which mean that the ultimate limits to growth may be built into the design of the economy. Things like the distribution of productive capacity in the coastal areas versus the interior of China and the high cost of developing infrastructure. Corruption might also be an issue in certain markets, especially those emerging markets. An important part of our infrastructure, as well as roads and bridges, airports, is the financial infrastructure. Have we got a banking sector that can facilitate trades, that can provide the liquidity that we need, and also serve as a market maker, a market sponsor for companies in those countries? If it's poorly regulated, unsupervised, if it's subject to periodic failure, then the banking sector could be the biggest problem of the investment sector. We also see, and we have seen, that international correlation tends to increase in periods of crises, and emerging markets are more likely to have those periodic crises. If we have a Russian ruble crisis or an Argentinian peso crisis, essentially that creates worldwide instability that results in decrease in that correlation. The thing that affects currency risk is going to be the same thing that affects the market value of the stocks, and so we see that currency risk is going to be outsized. And another factor is going to be the contagion. Things that affect one economy are likely to affect several others, reducing the value, the benefit of the diversification. The long-term view says that developing economies are much more likely to continue to grow at higher rates. If we have unmet demand in those markets, there may be periodic slowdown in growth, but the long-term trajectory looks much more positive for developing markets. Not just countries like India, China, Vietnam, Cambodia, Indonesia, Turkey, Brazil, but also some of the even less developed countries. In Africa, for example. Emerging markets have shown signs that they're improving. We see increased political stability. And so it means that there's going to be better opportunities to find good investments from among a large set of possible investments. Standardization of international accounting, improved standards of corporate governance on a worldwide basis have also provided significant improvements. We still see that there are problems with regulation and liquidity, that markets tend to be defined by systems of rules which are very different from one area to another, meaning that they stay segmented. And so we found it difficult in general to find a set of reliable investments in emerging markets, but non-country-bound investment models like those of MCSI and their frontier markets and emerging market indices tend to help us to be able to find stocks that are traded regardless of the nationality from those frontier markets. There's still restrictions that are going to be important in terms of things like foreign ownership, with in certain cases with industries that are considered to be politically important, like investing in media, perhaps investing in the banks, investing in infrastructure. Some of those things might be controlled. There may also be a limited amount of stock that are traded independently of the original owners. If the founders of a company continue to own 50 and 60% of the company, then there will be a much smaller float, and that's often the case in emerging markets. It may be difficult to repatriate your capital at the end of an investment, or the returns to capital like dividends and interest. Taxes on foreign investors may be higher. There may be tax advantages to local investors, which are equally discriminatory against foreign investors. Restrictions on moving foreign currency in and out of the country, and there may be restriction on who can invest in those markets. So in conclusion, what can we say? Portfolio improvements can improve investments in any standard portfolio just because of random diversification. Targeted diversification may be an even further improvement, but by investing in several different markets, and not just for bonds and equities, but across different national markets, we can improve on an already good portfolio. Adding investments from an underperforming market can even improve our Sharpe ratio if the correlation coefficient is small enough. Currency risks are something that we also need to take into consideration, though. We saw that emerging markets can provide diversification opportunities, although there are going to be significant barriers and risks, things that may even offset the growth opportunities. And diversification is also becoming increasingly difficult in a globalized trading economy with fewer barriers, higher correlation of markets, And we also see that this correlation increases in times of crisis.